Well, welcome back to the series on sound investing about the most important investment decisions I think you'll ever make, sharing with you what we know about these decisions so that you, as a do-it-yourself investor, will make the best, most productive decisions. Now, I am not going to do a piece on stocks versus bonds, the $20 million decision, because I already have. And that is, we'll have a link to that in our note field. And I mention that because that was the first, and in some ways, the most important decision that we make, and that is simply the choice of equities versus bonds. So I hope you will join me for that presentation. That is then followed by another presentation. Just there we go. This one is entitled The Ultimate Buy and Hold 2024 Update. I've been doing this presentation since the 1990s. And again, we'll have a link to that. But the value of that particular presentation is about the equity asset classes that the academics tell us that there's good evidence should produce a decent return in the future, a premium for the risk that you will take. And so we do something which I think is really fun, and that is we build a portfolio out of all 10 of those equity asset classes. And what happens to the return as you add each one? I think you'll find that helpful if you haven't seen it. But now we have today's focus. In this particular presentation, and we did a little bit of this in the Ultimate Buy and Hold presentation, but here we're going to dig into the portfolios of those approved equity asset classes. We're going to mix them and match them, and we're going to put them together in different ways so that you can see the implications in terms of returns. And of course, we're doing the same thing everybody else does. We show you the past, and we hope that the future will look something like that. But we also want to show you not just the past good times or just the compound rate of return, but what do the different periods look like? How do these different combinations of equity asset classes compare to each other in good times and bad? What about kind of growth versus value? What have we learned there over the long term? You're going to see that. And it all starts with this set of strategies. On the left-hand side here, we have the portfolios. The first portfolio is the S&P 500. Now, you could, in fact, have, for a lifetime, one portfolio. It could be the S&P 500. You could put your money into the S&P 500 for the rest of your life. And there are a lot of people that believe that is an intelligent thing to do with no bonds, with no defense. And we're going to talk about that in one of the upcoming presentations. But it's here for two reasons. One, because it is a legitimate portfolio. But two, it is the benchmark. It is the most common portfolio that people have, or the most common equity asset class that investors have. And it is virtually the same as the total market index. So whether you want to put that money forever in the total market index or the S&P 500, if we look back at the last 96 years, the return is like 1/10 of 1% difference, with the advantage going to the S&P 500. So we have that as one portfolio. We consider that to be something to compare the others to, since so many people have it. Now, the second portfolio is the Ultimate Buy and Hold. That's the 10 different, all 10 of these equity asset classes, little bits of each one, so that you have between the S&P 500, large cap value, small cap blend, small cap value REITs, international large cap blend, value, small cap blend, small cap value, and emerging markets. You have got probably 15,000 companies in your portfolio. I mean, it is a huge. Now, I was going to say it was a huge amount of diversification, but what is different here that is different than somebody who might put together a balance of the total market index US and the total market index international. You could do that. In essence, you would have one basic equity asset class, although it would hold a lot of growth and some value, and you would have relatively few equity asset classes. You wouldn't have this full range of the 10. And notice that it's 10% each. So that's a different strategy than a lot of people know as an investor. See, a lot of people invest based on cap weighting their portfolio. When you have the total market index as your portfolio, the biggest 50 companies in that index are going to drive that return. They are going to be responsible for that return. At least that's the way it's been historically. Now, the 50 biggest will change periodically. So it's not always the same 50, but it's the biggest companies that are pushing the growth forward. Here we have what's called asset class uh, allocation here. So you want to divide it. You could say I want half in large and half in small. You could say I want half in large growth, half in small value. There's a whole bunch of ways you could arrange this in order to build a portfolio. In this particular ultimate buy and hold portfolio, and ultimate doesn't mean about the returns, because you're going to see in just a second, there are lots of combinations that make a lot more than the ultimate buy and hold portfolio. You're just going to have to wrestle whether it's too risky for you. So we'll get into that in just a few minutes. But now you have then the ability to look at some numbers, dig deep into the returns of the ultimate buy and hold. Then we have the four fund, the worldwide. Notice the worldwide is 25% S&P 500, 25% US small cap value, 25% international large cap value, and 25% international small cap blend. So basically, you have what you have in the ultimate buy and hold strategy, the balance of large and small and value and growth. It's almost the same with the exception of the slice of REITs and a slice of emerging markets. But what you've done is you narrowed it down to 4 funds in your portfolio instead of 10. And for some people, that would be an advantage because it would be simpler to manage. Then the next one here is the 4-fund US. The 4-fund US is real simple. 25% each, S&P, large cap value, small cap blend, and small cap value. Now you notice I'm not telling you what funds to be in. I will suggest some in future presentations here, because that takes some time to develop as well. And I do want you to have the help to pick those funds or those ETFs. And by the way, by the time we get there, I'm going to have the help of Chris and Daryl on these presentations, because Chris Pedersen is the one who has been responsible for building our best-in-class ETF recommendations. Then we have the worldwide all value. Now that is interesting to a lot of people, because in a sense that has virtually no growth in it. None of the fancy big. In fact, this would be Warren Buffett on steroids. In that he has, I think, 50 companies in his portfolio, and their value, when they are purchased, they were value-oriented companies. Not all of them are today, but I want you just to see with that portfolio, It's 25% large cap US value, 25 small cap value US, 20% international large cap value, 20% international small cap value, and 10% emerging markets. So now we've got 5 funds to work with and a very different return pattern. This is what I find fun about this, is because you may see that 2 strategies, 2 combinations have virtually the same return, but they don't perform well at the same time. They're heroes or they're goats at different times, which makes it kind of interesting in trying to figure out, okay, how much patience do I have to be in a goat when everybody else is doing well? Then there's the US all value. Get rid of the small and large international and just have US large cap and small cap, 50% each. Then there's a worldwide all small cap value, very aggressive, very volatile compared to these other portfolios. And then you have their 50% in US and 50% in the international. And then finally we come, actually the all small cap value. I don't think anybody's going to make a portfolio for life of that, but I'll tell you something. If somebody, for example, in their early 20s wanted to put all of their first 5 years of 401k or Roth IRA investments into small cap value, then just leave it there. You don't have to put any more in, just leave it there to do its thing for the next 40 or 50 years. It could be a great long-term investment. One of the most interesting investments to me is the 2-fund strategy, because it basically, with 2 funds, 50% S&P 500, 50% small cap value, you've got great exposure to value. You've got good exposure to the S&P 500, which is a combination of growth and value. And you have good exposure to small. So you do have 4 major equity asset classes really working for you. And you'll see that it's very similar to many of the other portfolios. Okay, let's go look at some numbers. Now, there's a lot here. Really, it isn't very complex. This is Daryl's work, Daryl Ball's, trying to give people a bunch of numbers. Too many for some, but I'm going to have you just look at a couple of them. So don't think you have to know them all. But did it in a way that I feel gives people a better sense of what these combinations are likely to respond to, how they're likely to act in different markets than any presentation that I have seen. And here's what he's done. First of all, for those people who don't want to know anything more than how much money would I have made, the first line tells you from 1970 to 2023, having invested over that 54-year period, $10,000, not adding money, not taking money out, how much money would I have had at the end of that 54-year period in the S&P 500? 2,387,715. Now, what does that tell you about the next 54 years? Well, you know something? It might not shock me. I will not be around to know that it might not be very different from that, because that compound annualized growth rate, the CAGR, you'll see it in the blue box right below, 10.7%. Now, that's a little higher. Well, it's more than a little higher. I think the 96-year rate is about 10. But now we're going to continue across this top line, because this is for the people who simply want to know how much money would I have made. The ultimate buy and hold would have been 4,375,000. The 4-fund worldwide, 4,689,000. The US 4-fund, 4,860,000. Now notice there's not very much difference between the US 4 fund and the worldwide 4 fund. And probably there isn't much difference because they are basically trying to get at the same equity asset classes: small value, small blend, large blend. And they did it in two different ways. And it's amazing. Now, they didn't get the same return every year. That's the other part that we're going to look at in just a minute. That all value portfolio worldwide, so you've got both US and international, 6,216,000. The US only, just the two funds, large and small, 7,412,000. The all small cap value worldwide, 108,825, and the all US small cap value, 10,288,000, and the two fund strategy, half US small value and half S&P, $5.5 million. So now, for those of you who don't care about kind of when it came and how it came and how it compared to others, you don't have to go down below, but I hope you will. Because in the first box, Daryl here in the blue box has given us, first of all, the compound rate of return for each one of these long-term returns. And you can see while the S&P 500 was 10.7, all of it buy and hold, 11.9, four fund worldwide, 12.1, four fund US, 12.1, all value, 12.7, US, that was a worldwide, US all value, 13, small cap value, 13.8, all small cap value, 13.7, and the two fund strategy, US, 12.4. So the range was from 10.7 to 13.8. And the difference in what you have in your pocket at the end of the period is from 2.4 million to 10 million 825. So that is the entire period. But then what Daryl does to prepare us, because this is what we need if we're going to stay the course for the rest of our life in a strategy. And this is only the equity portion. We'll be talking about the fixed income portion in the next presentation. But I want you to see here, from the period 70 to 79, the compound rate of return of all these different strategies from 5.8 to 17.2. I mean, that's a huge range, a huge difference. And obviously, over that 10-year period, value did better than growth. Then what Daryl does in order to help you understand the differences between these different strategies and when they produce, when they're profitable, when they're not. He's broken all of these down into decades. Now, decades are not a lifetime, but decades are enough time that at the end of that decade, if you haven't done well, it is discouraging because we have this problem with the bias of recency. And if something's been doing well for 10 years, it is hard to imagine it's going to do well for the next 10 years. But here's what we know from 70 to 79. We know that the S&P 500 compounded at 5.8. Over here, small cap value worldwide, 17.2. It's pretty obvious this was an amazing period of time for small cap value. But there are other periods it won't be so amazing. I'll show you that in just a minute. But you can see that whether it's from 70 to 79, 80 to 89, those were great times. Both 80 to 89 were amazing decades. 17.5, 23.5, 26.7. I mean, they're all great numbers. And I don't think anybody would have complained about any of those returns. Now, interestingly enough, in the next decade from 90 to 99, if they were going to complain, it would be about small cap value because it made half of what in fact, less than half of what the S&P 500 did. And by the way, the star performer during that particular decade was the S&P 500. So while they don't have the greatest long-term performance, they're going to have lots of periods they are number one. They were not number one in the period from 2000 to 2009. In fact, they lost money compounded over that period of time. And if you had retired in 2000 and you were expecting the S&P 500 to support you to take out 6% a year or 5% a year, you could be in real deep trouble by the end of that decade. And the others did better from a high of 10.5. Here again, we've got small, well, I'm sorry, 10.5 small cap value, the worldwide all value at 8.5, the four fund worldwide 6.1. In fact, the US was only 4.8, so you were better off having internationals in that decade and value in that decade. And finally, we look over the last years since 2010, and we can see that once again, the S&P 500 is a star performer. So there is nothing that works the best, all the time. I can tell you though, I just feel that if I could accept the risk of an all value worldwide portfolio or the U.S. all value portfolio, either one of those would have, in fact, been really good performers, kind of in all types of markets. Now, to help you compare the good times, because that's what these investments have. They have years where they're up and years where they're down. And it's good to get an idea of what that is going to likely be like. And here again, I think Daryl does us a great service in breaking out how did they do just in the good times. Well, the S&P 500 had 43 up years and only, by the way, 11 down years. So, that's 25% of the time you're approximately 20 to 25, you're going to be underwater, oftentimes by very little, and sometimes by a lot. And also with the up years, sometimes those profitable years are small, and sometimes they are absolutely fantastic. But there were 43 of those good years, and if you sum up all of the good years, it's 813.3% you would have made during that. That does not include the compounding effect, but if we just add up all those good years, that's what it would have been. And we can compare it to the others. And you can see as you move across here, the sum of the gains go from 813, 880, 895, 890, 920, 941, 1,015, 1,039, and 894. You know what that tells me? That all of these were profitable, had beautiful, great, profitable years. But the combinations all outperformed the S&P 500. Now, I think we should not be shocked by that. These combinations, all of them, did better than CDs did over this period of time. Well, why did they do better than CDs? Because they were more risky. Why did the worldwide ultimate buy and hold or the 2 fund or the 5 fund, whatever, why did they do better than the S&P in the good times? Because they are more risky. So we need to look at that risk and see if legitimately they are more risky. Now, see, the one way we know they are more risky is we can see the standard deviation down here below the red box. And the higher the number, the higher the volatility. And so you could maybe conclude that everything was more risky than the S&P 500 because the standard deviation for the S&P 500 was 17.2, and they were all higher than that. But that's only a measure of volatility. And by the way, it includes the good times too. So it's not bad to be volatile on the upside. But now we need to look and see, what did it look like on the downside? And when we go to the downside, we see that they all either they lost from, let's see, here's one, 9. Worldwide all value had 9 losing years. The S&P 500 had 11. In fact, 3 of them had 11, and 3 of them had 12 losing years. One had 13. 2 of them had 13. Then, of course, the one we mentioned that was 9. So they all had a number of losing years. But what about the sum of the losing years? Because if you had 10 really small losses and one big one, that might actually, when you sum up all of those losses, make you look pretty good. Yeah, you would have had to live through one big one, maybe. But if you look at the sum, there's a message there. And the sum of each one of these is here. So you can see with the S&P 500, it's 159%, the total of all the losing years. But as I look across the page at the rest of them, they are all but one lower. And the one that had more, if you add up all the losing years, was small cap value, US only. And all that tells me is this, that any of these combinations would have had kind of, let's call them similar gains and similar losses. That if we didn't see the names of the portfolios and we just saw the performance of the portfolios on the upside and the downside, I wonder how we'd go about deciding which is the best portfolio. I think well, as a matter of fact, let me take you one more step here, because I want to look at a few so we don't have to deal with all of them, and see if we can kind of figure out how we might think about these. I want to look at 4 of these. Now, I really think that you, if you did narrow it down to 2, should do this. Take them out of there where they are on their piece of paper and put them next to each other and compare them, or put your finger and go down the two rows. But I've made it easy here. I've got the S&P 500 and I got the ultimate buy and hold. And I can just look at those 2 if I wanted to. And I could see that the ultimate buy and hold had about a 1% advantage at the end of 10 years. Remember, we think a half of 1% is a big deal for extra return, but 1 is a big deal. Is even better, more than 1. 70 to 79, not a good period for the S&P 500 versus 13.3. 17.5 for the decade of 80 to 89 versus 22 for ultimate buy and hold. 18.2 for the S&P, 10.1 for ultimate buy and hold. Then you have that tough period from the lost decade, they called it, -1 for the S&P 500 compound return versus a gain of 7.3. And then the last years, 13.1 for the S&P 500 and 8.8 for the ultimate buy and hold. By the way, are you surprised that when people look at recently, they have concluded that the good times for value, they're over. For international, they're over. Just got to have the S&P 500. That's the way people felt, by the way, back in 1990 or 90. Well, actually, at the end of this 90 to 99 for sure, because it was an 8% difference for the worldwide ultimate buy and hold. And then you can go ahead and you kind of look at the ups and the downs. They both had 43 good years, profitable years, and they both had 11 unprofitable. What's interesting is the average loss for the ultimate buy and hold is lower than the S&P 500. Although, if you look at the sum of all of the losses, 159.2 for the S&P and 149.4 for for the ultimate buy and hold. Remember, that compound rate of return was 1.2% more. Now, if I had just those two to pick from, I would pick for the ultimate buy and hold. There's only one really big problem, and it's not a small one. It means you got to fool around with 10 different, and by the way, then you add bonds to it, maybe it's 12 or 13 different investments. So what if we go the next step? What if we go to the step and we compare the ultimate buy and hold to the worldwide all value? That's another worldwide strategy. You'll notice it's adding about $2 million. Well, that's encouraging. Makes it look like it's something we might want to consider. And here, when you start breaking it down, now we've chosen the ultimate buy and hold over the S&P 500. But now that we look here at the all value worldwide, 12.7, you have added almost another 1%, 0.8 of 1%. And then as you look at the decades, 13.3 versus 14.4 for 70 to 79, 22 versus 23.5, 80 to 89, 10.1 versus 10.6, 90 to 99, 2000, 2009, 7.3 versus 8.5. And then finally 8.8 from 2010 to 2023 versus 8.6. The worldwide ultimate buy and hold strategy only outperformed one period. And it was by 0.2%. And out of that would have come this difference between 4.3 and 6.2. So what that might mean, even if you didn't put all of your money in worldwide all value, you might decide to do your Roth IRA there just as a part of your portfolio. And it does have 5 funds. Now, you could also later go compare it to the 2-fund all value US. And of course, I could have done more of these here, but I just picked these 4. And I'm such a fan of that 2-fund strategy. I thought that would be interesting to compare because it does almost as well. 12.7 for the compound growth rate over the whole time versus 12.4. Notice there were periods when you had a decided advantage here to the 2-fund strategy for 2 decades. 2 decades, it underperformed the worldwide all value. And then in 90 to 99, the 2-fund strategy did better. Then the next decade, the worldwide did better. Then the next period of time, the 2-fund all S&P small cap value did considerably better. But I would say more than likely, because these numbers are close, that either one of those portfolios could have a great return. I also want you to notice that the 11.9 in the ultimate buy and hold versus the 12.4 or the 12.7, I mean, that's worth a look because you're talking about potentially another $2 million here or another million here between worldwide ultimate buy and hold and the 2-fund strategy. And remember, a lot of that is driven because you don't have REITs. REITs are very much like the S&P 500 in return. So when you take them out, it means you're going to have more of the other stuff. But you can then look at the up years and the down years and find what's most comfortable for you. Or again, as I suggested a minute ago, would it be worth considering the possibility of finding, maybe you have 3 or 4 portfolios in your household that are all dependent. Maybe there's a couple of IRAs, a couple of 401ks or a 403b, whatever. You could mix and match these strategies, but certainly you would want to be in those that you're comfortable with the risk on the downside and willing to wait out some periods. As a matter of fact, of all of these, the one where you have to wait so much of the time turns out to be the S&P 500, because you had this one decade of 5.8 and the other decade of a -1. None of the rest of these have that. Well, sorry, here's a 4.2, but that happened when this had a -1, so you're probably feeling good about it. I hope that helps give you some sense of how you might. By the way, I don't expect you to read these numbers, but I know you have these here, and we will put a PDF, a link to a PDF in the notes, so that you'll be able to print that out easily. But all this does is take every one of these portfolios and have you look at every year if you wish. We're talking about you planning something for a lifetime. You finding a way to add an extra 1% to your portfolio, maybe. And I think it's worth some time really understanding. And by the way, I want you to see something I think is pretty magic. If we only looked at the negative years for the S&P 500, just a single year, we get beat up emotionally with a single year. If that single year is down, we don't seem to get beat up emotionally when it goes up. So what you see here is 73 and 74 was not pretty really for anybody. But I would say that nothing stands out as a hugely more risky portfolio than the S&P 500, which is in essence, the conservative one. Now that worldwide all value, it did about the same as the S&P 500. And yes, there were many of them that were slightly higher than the S&P 500. But then all you have to do is look at the next 2 years and see how the S&P 500 did. Whoa, up 37 and up 24. But then you look at the worldwide ultimate buy and hold, up 46 and up 26. The worldwide 4-fund, up 47, up 23. The 4-fund strategy, US, up 51, up 43. The worldwide all value, up 53, up 27. I mean, the rockets, the ones that rebounded the most were everybody else but the S&P 500. It did just fine, by the way, and nobody was complaining. But if you look at these other portfolios, having some of that small cap, having some of that large value, as well as a small cap value, that's a big deal. Then you could go down if you want to just take a few more seconds here and look down at the 2000 through 2002. People gave up then. People gave up because at 3 losing years, we think recency is meaningful. We think linearly. Both of those biases happen to cause a lot of people to get out and say, I can't take any more of this. Well, I'm not saying it was easy with the other strategies, but I'll tell you, if you look at the S&P 500 with a -9 and a -12 and a -22, and you compare it to the others, you will see, for example, the ultimate buy and hold a -1.5, 2, and 8. Or the 4-fund worldwide, -1.2, -4.5, -9.5. The US 4-fund +4.1, +6.4, -16.3. I think you're getting the picture that the broader diversification has saved you from the misery of those terrible years. But then we have to look at 2008. They all performed poorly for that 1 year. But I do want you to notice that coming out of that one bad year, how well the other portfolios did in 2009 and 2010. They did well. By the way, the S&P 500 didn't do poorly, but the rest of them ran away from the S&P 500. So my view is the risk on the downside with these more diversified portfolios that have more than just large cap blend in them, whether it's all US or all US and international, that is a world apart in terms of how you manage risk when you build portfolios that pick up these additional asset classes. So, as always, we really appreciate the fact that you're willing to sit through these presentations and really give yourself a chance to understand the evidence, the past evidence. And you may even from comments, give us comments about what you wish we had done. We're always interested. I would never have thought of doing what Daryl did. That was his idea, not mine. And notice that coming up next, we have the fine tuning your asset allocation 2024 update. Now we're talking adding bonds to the portfolio. So I do hope you will join us next week for that presentation. And if you didn't see those earlier presentations that I talked about, they are in the note field. You can follow up if you would like. And of course, you can share right here. You can share, you can subscribe, you can give us a like. And I'm not begging, but I'm just saying that some people, and we are a 501c3, and all the work that I do and all the work that Chris and Daryl, what they do, we are all volunteer all the time. We have a few people that we pay to do the hard work, and we really appreciate their work. Margie, she's with us right now. You don't ever see her. She's in the background taking care of stuff and putting this all together for me. And all I can say is, boy, am I glad to have her help. She's been with me here, I think I think it's over 11 years now. So, Margie, I know you're there. Thank you for everything that you do as well. So we'll see you next week. I hope some of this was helpful. Good luck.